stopped thinking of the opportunity zone as a tax strategy and started thinking of it as really the most favorable long duration investment structure that Congress has ever put in the tax code. And then I would ask yourself, is the underlying fund and investment opportunity one you want to own for over a decade? And if the answer is yes, then you make the investment. And if the answer is no tax benefit's going to save you.
Hello and welcome to What's Next, a podcast from Parsion Private Wealth. I'm your host, Terry Cook. In What's Next, we discuss the difficult questions that arise when business owners and entrepreneurs begin to plan for their next chapter. The questions that present themselves through transitions like these often span a wide breadth, from complex financial strategies to emotional conversations around legacy considerations. If you're moving towards your What's Next, we're here to help. Today we are discussing Opportunity Zones 2.0, one of the most significant updates to the tax code for business owners planning a liquidity event. On July 4th, 2025, as part of the One Big Beautiful Bill Act, Congress made Opportunity Zones a permanent feature of the tax code. That single change, paired with a rolling 5-year deferral that starts the day you invest, a restored 10% basis step-up, census-tracked redesignations every 10 years, and a new Rural Opportunity Fund provision has created a powerful tool for business owners who want to mitigate taxes from the sale of a business. That single change, paired with a rolling 5-year deferral that starts the day you invest, a restored 10% basis step-up, census-tracked redesignations every 10 years, and a new Rural Opportunity Fund provision, has created a powerful tool for business owners who want to mitigate taxes from the sale of a business. In this episode, we walk through what the new law actually says, how permanence changes the planning conversation, what a coordinated strategy looks like when paired with other tax mitigation solutions, and what a well-executed project looks like on the ground. We include a short Washington State footnote for our Pacific Northwest families, and we close on the questions a sophisticated investor should be asking before committing capital to any Opportunity Zone investment. And to guide us through all of this, we have Nick Rosenthal joining us today. Nick is the co-CEO of Griffin Capital, one of the most experienced Opportunity Zone managers in the country. Griffin has raised more than $2 billion across multiple funds and is currently developing over 30 multifamily and student housing communities across the United States. Founded in the mid-1990s and now in its 31st year, Griffin is a real estate investment management firm with roughly 85 employees across acquisitions, asset management, portfolio management, construction management, and research. The firm's rental housing portfolio is now a little over $4.5 billion. Since inception, Griffin has sponsored or co-sponsored $24 billion of investment strategies, and Nick and his senior leadership team have co-invested more than $300 million of their own capital alongside those investors. That level of alignment, combined with Griffin's deep experience developing within Opportunity Zones, makes Nick the ideal person to help us understand what has changed, what is new, and what matters most for business owners preparing for a sale. He's the perfect person to help us through these topics. Let's dive in. Before we get into the legislation, let's start with you and Griffin Capital. Our listeners are business owners, people who have spent decades building something valuable and are now thinking hard about what they do with what they've built and keeping more of what they've built. So help them understand who Griffin Capital is, how you think about your investors, and honestly, how you ended up so deep in the Opportunity Zone world.
Sure, Terry. First, your listeners really resemble what we went through with our business. So as a firm, we've been around since the mid-90s, celebrating 31 years this year. We are a real estate investment management firm, historically invested across all different sectors of the property markets. So a multi-sector investor in a variety of different investment vehicle structures. Today, we're 85 employees across acquisitions, asset management, portfolio management, construction management, research, obviously a middle and a back office to support reporting to our investors as well. But we focus on the rental housing space. And to your point, that portfolio is a little over $4.5 billion today. And we decided to focus our business on that segment of the market because it was our view that we saw very strong demographic tailwinds that would support secular demand for rental housing in this country. We have big affordability issues. We haven't created enough single family housing. And so from an investment perspective and from wanting to serve the communities in which we invest, we felt like there was a real intersection there. And we express that in a lot of different ways. We buy stabilized assets, we develop assets. But as investors ourselves, and because we invest alongside of our investors, we think about ways in which to execute these strategies in a manner that creates tax efficiency. And so as we think about our own capital as investors, it's really about improving financial planning outcomes, minimizing taxation over time, and generating good investment outcomes. And so that's really how we think about investing and focus as a firm. And we ourselves went through a fairly large transaction in 2022. So what we know is that when you think about planning on the front end of these large, really formidable moments in a financial planning journey, you tend to get better outcomes. And these strategies are great tools to help with respect to that.
It's an important point that you just made, and I wanted to call that out a little bit. The fact that Griffin's own senior leadership team has co-invested more than like $300 million alongside your investors. Not a marketing line, that's alignment. And that number is striking because we see many times in this business the people offering the investment are not that heavily invested. And you mentioned a little bit about this just now, but walk me through what that co-investment commitment actually means for how you evaluate a deal. Does it change anything?
Yeah, absolutely. I think it does. I mean, since the inception of our business, we've sponsored or co-sponsored, as you articulated, $24 billion of investment strategies. We have put ourselves next to our investors to the tune of $300 million of capital over those different investment strategies. And really the thought process that we have as investors is this something we want to do with our own balance sheet? Because at the end of the day, if we don't raise capital, bring in investors, don't execute, it's really our capital on the line. So skin in the game matters. I think it tends to matter most when things go sideways. And as we are in a cyclical business in the real estate space, having alignment through difficult times is really important. You fight harder, and you are very focused on getting to the right outcome, not just because you have a responsibility to your investors, but because it is your own capital on the line as well.
Yeah, much more of the families we serve understand partnerships, and so much more as of a true partnership there. All right, so let's level set for any listener who may be newer to the concept of opportunity zones, or maybe looked at them back in 2019 and for whatever reason might not have dug in further. And I want to give my kind of plain English version before I hand it over to you, Nick, on this, and I'll give it a shot, and you can correct me or add whatever I miss out. But here's how I explain it to a client. You sell your company. You got a significant taxable gain. Let's keep it round numbers, say $10 million. The government says if you take that gain and reinvest it into a designated low-income community within 180 days, we'll let you defer the tax on that original gain, potentially reduce a portion of it. That's that step up, which we'll talk about. And if you hold the investment for 10 years, we'll eliminate the capital gains on all the appreciation generated by that investment entirely. It's not a loophole. That's a deliberate congressional program designed to direct private capital into communities that have historically been underinvested. Nick, where did this come from? What problem was Congress actually trying to solve? And from your seat, has the program delivered on that original promise?
Sure. So ushered into the tax code and the end of 2017 in the Tax Cuts and Jobs Act. Co-sponsors were Cory Booker and Tim Scott, so two senators, opposite sides of the aisle, but broad bipartisan and bicameral support here. And the thought process at the time was that there's $6 trillion of unrealized capital gains in the private sector. And how could we get sufficient motivation to drive some of that capital into designated census tracts on a long-term basis to create socioeconomic mobility within those communities? And so this was really originally the brainchild of Sean Parker, so entrepreneur, founder of Napster, first president of Facebook, and then the Economic Innovation Group, which is sort of the preeminent socioeconomic think tank, worked in concert with Sean Parker to really advance this. And it originally was something that was looked at by the Gates Foundation, the Clinton Foundation, and others that were really thinking about philanthropy and how to drive, again, capital into certain census tracts across the U.S. Kevin Hassett was very instrumental in the legislation getting passed initially, wrote a research paper that was sort of the framework for what the bill ended up being. So it was a long journey prior to the Tax Cuts and Jobs Act being signed into law. And initially, it was a temporary program. Now under OB3, which we'll talk about, it's now ushered into the tax code as a permanent program. But again, the idea here was, how do we provide people sufficient motivation to drive capital on a long-term basis as a place-based economic tool? And it's been extraordinarily successful. So what we know for sure is over $120 billion, a lot of folks estimate more, has gone into this program since the end of 2017. Hundreds of thousands of housing units have been built with this capital. So we know that we are woefully undersupplied from a housing perspective across the U.S. Being able to drive capital, particularly in a period where interest rates were going up, construction costs were going up. There's a lot of uncertainty over the last several years for discretionary real estate capital. Being able to generate capital formation for real estate through this program has been incredibly additive for the communities that have received this capital. And when you compare it to similar census tracts that did not get designated, we see better job growth, we see more housing. So by all accounts, it's been an incredibly successful place-based economic tool to drive private sector investment.
Yeah, and the key there as well is the bilateral support from the very beginning, right? And that's an important aspect. And nice job working Napster into the conversation too. That's a throwback. I learned something though. I didn't know Sean Parker was part of the impetus on this. There's been criticism over the years. You don't need to spend a lot of time on this, but that Opportunity Zone capital flowed to areas that were already gentrifying. That the community impact was hard to measure. How does Griffin think about that, and how do you evaluate whether a deal is actually meeting the spirit of the program, not just the letter of it? And like we're investors here, right? We're also trying to make money out of this, or actually first and foremost, it's not just about tax savings; it's the investment opportunity. So, how does Griffin think about that, and where does that come into?
So I'm going to answer that in a couple ways. So the first way I would address it is, if you think about the way zones were nominated, they had to fit several criteria. So certain poverty rate thresholds, as an example, median household income thresholds, as an example. And the governors of respective states were able to designate up to 25% of the eligible census tracts within their respective state. So, there was a broad spectrum of effectiveness across different governors of different states in terms of designated tracts in which private sector capital wanted to invest. And there is idealism, and then there's pragmatism, and where governors did a good job of marrying the two, they saw a lot of capital investment. So private sector capital generally speaking, is going to go where risk-adjusted returns are the most attractive. And you see that in terms of where capital has gone in this program. What I would submit as we think about it through the context of our business is when you think particularly about rental housing, most people rent in communities that they could not ordinarily be able to access. So by creating more housing closer to those school districts in which they want to live, the employment nodes in which they want to work, the transportation corridors that allow them to get to their jobs, allow them to get to their kids' activities. Those are how people think about where they want to live and where they select to rent. So by creating more housing, what we know is housing becomes more accessible, becomes more affordable. So, we as investors did not take existing structures like housing out of commission. We took vacant land, dilapidated retail or parking lots as examples that weren't being utilized for their highest and best use and turned them into housing. And so certainly there's criticism. And I think a lot of the criticism early on was really related to a hospitality project in the state of Oregon in downtown Portland, actually. And Ron Wyden in particular took exception to that use case. I would argue if you look at where dollars have gone by and large, they've gone predominantly in the real estate space to housing. But even something like a hospitality project creates a lot of jobs, creates a lot of ongoing jobs, and a flywheel for economic stimulus. So if you have the infrastructure with hotels in a city, you have the ability to attract conventions, you have the ability to attract sporting events. All of that drives revenue to local businesses, creates more socioeconomic mobility. So these dollars, by and large, have gone to creating real estate infrastructure, and that real estate infrastructure creates long-term economic stimulus in the communities that receive it. So, I would submit, as we look at the program broadly, it's been incredibly successful.
Yeah, makes total sense. So on July 4th, 2025, as part of the One Big Beautiful Bill Act, which, what do you call it? Triple B?
We call it OV3, and we
OV3.
actually spent a lot of time on this.
Okay.
So know it very well.
Yeah, it's a mouthful. July 4th, 2025, Congress made Opportunity Zones permanent. No sunset. No, will this still exist in 3 to 5 years? That alone fundamentally changes the planning conversation, certainly from our perspective. But they did a lot more than just extend it. Let's walk through the 5 changes that matter most for our audience, and the first being permanence. The program is now a permanent feature of the tax code with census tract redesignations every 10 years. So, Nick, I want to start here because I think permanence is underappreciated. When a program has an expiration date, advisors and investors, they hedge. It loses its certainly appeal as you get closer. And I'd love for you to comment on whether you've noticed that from your end, and what does permanence change both for how sponsors like Griffin build funds and for how a business owner should think about planning a sale 2 or 3 years out?
Yeah. So to your point, big transition period that we're in right now for the Opportunity Zone Phone program went from a temporary program expiring at the end of 2026 to a permanent program starting January 1st of 2027. And I think you hit the nail on the head, Terry. I mean, when you have a temporary policy, it is hard for firms like Griffin and others to build large infrastructure with the uncertainty of whether that program is going to continue to be there. So all of the expertise around compliance, legal structuring, all of the nuances to conform to the program, if you think that program is potentially going away, maybe you stay out of the space. And so I think what you're going to see is a lot more market participants come into the space. I think you're going to see the institutionalization of the Opportunity Zone Fund investment management capabilities that I think investors will benefit from. And I think from a planning perspective, to your point, knowing that you have a tool with defined rules that don't diminish over time allows you to be really thoughtful in how you approach this strategy, particularly if you've got time to think about it. And we'll talk through this, but as you get closer to the expiration of the program here on December 31st, 2026, you certainly see a deceleration of capital going into the program. But now that you've got permanence starting January 1st of 27, we see a significant amount of interest in people preparing for that. So we see it in investor conversations all day, every day. And now that it's something that they're going to be able to rely on with a set of benefits that don't diminish over time, it's going to be a tool that I think most folks will lean on as they think about liquidity event planning or just how they deal with capital gains in their portfolios.
Not to mention on the developer or the manager's side of this, to be able to now know and plan for that permanence, right? From the Griffin Capital standpoint.
That's right. And Terry, the thing that I'd add too is if you know the program is each designation of census tracts are going to last for 10 years at a time, as you articulated. You can think about larger scale projects where you view capital formation to be ratable over time because you don't have a diminishing set of benefits. You can potentially think about multi-phase, larger scale projects, and I think that allows governors to think about how they drive capital in a scaled way over time into different parts of their state. And it's going to be a very powerful tool for them as they think about economic development. We're actually having those conversations with their economic development offices now.
Yeah. And I could see it from the investor's standpoint and being able to be more strategic about how that's rolled out and where it's rolled out or implemented. And so under the old program, and I think this is goes along with the permanence. Under the old program, the deferral period ended on a fixed date, December 31st, 2026, regardless of when you invested, which created real inequity, right? Someone who invested in 2024 or 2025 got almost no deferral benefit. But under this 2.0 version, the 5-year deferral clock starts from the date you invest. You put money in on March 1st, 2027, your deferral runs until March 1st, 2032. That's a meaningful structural improvement. Nick, what does that mean in practice for an investor who's planning a sale in the next year or two?
Well, first of all, to your point, it democratizes timing, right? So there is no diminishing benefit over time for investors. They know that when they sell and trigger a gain, their clock starts to invest in an opportunity zone fund. And once they fund that investment, they've got 5 years of deferral from their date of investment. So now we have a set planning horizon, which allows us to think about things in a variety of different ways. I think the dynamic that we think about is if I know I have 5 years before I have to recognize a gain, I just got an interest-free loan to invest in something that's going to grow long-term tax-free, and I know when the maturity date of that loan is coming, and I can plan around it and potentially minimize it. So I think that's hugely beneficial. I think another dynamic as we think about it is, if I was selling a business and thinking about potentially an installment sale so I could spread my capital gains recognition over time previously, the Opportunity Zone Fund wasn't necessarily the best tool for that because no matter when I invested in whatever tax period I made that investment, I had the same recognition date at the end of 2026. Now, if I'm thinking about selling a concentrated position or selling my business in an installment sale construct over multiple tax periods, and I can fund my Opportunity Zone Fund investment in pieces, potentially, number one, I can get exposure to different vintages of real estate over time, which is beneficial from a diversification perspective. But I am also now recognizing that gain over different periods. And that allows me, obviously, to improve my planning outcomes. And so I think that dynamic is really beneficial from a planning perspective.
Super interesting. Yeah, you're almost taking us to the graduate course there with the installment sale, but that just kind of speaks to what you're saying. Now with this certainty, both on the deferral and the permanence of it, there's all kinds of additional planning structures you can put around this. Even outside of that, as you're planning for the recognition 5 years later, there's different things like these, the tax-aware strategies, tax loss harvesting strategies to help mitigate those gains in the future. So it really becomes quite interesting and even quite fun putting something together here to show some real value. And then the third aspect is that step up, that 10% step up. The 2.0 version of Opportunity Zones not only brings back the basis step up, which had gone away over time in 1.0, and that's that investors who hold for at least 5 years get a 10% reduction in their original deferred gain. So not just deferral, but an actual reduction or elimination of 10% of that. So if you've rolled in $5 million at the 5-year mark, you only owe tax on $4.5 million now. It's not enormous in isolation, but combined with the deferral thing, it matters. So walk me through why the step up is more significant than it looks at first glance, especially when you factor in kind of the passive loss strategies available in a limited partnership structure.
Yeah, I think that's a good point. So as you referenced in the 1.0 legislation, there were step-up benefits at the end of the deferral period, but they went away over time. So previously, if you had been invested for 5 years, but not 7, prior to the expiration of deferral, you were eligible for a 10% basis step up, which means you had to make your investment in 20 or 21. If you were invested for 7 years, you got the benefit of an extra 5% for a total of 15%. So that obviously went away at the end of 2019. So over time, this benefit has diminished and eventually went away. In 2.0, the new program, every investor, to your point, that holds for 5 years is eligible for a 10% reduction. So you owe tax on 90% of every dollar deferred by investing in the Opportunity Zone Fund, not a dollar. I would analogize this to it's a discount on the bill you are going to pay anyways. So that's right. Obviously a great benefit.
Right.
But if
it's
you
found
think about
money
it,
at that point.
100% found money. So again, you're getting an interest-free loan for a period of time, and at maturity, you don't owe par value, you owe 90 cents. And I think that's certainly a nice benefit. But if you're able to combine that over a 5-year period now with things like bonus depreciation and cost segregation like we get in the real estate business, you can accumulate a fair amount of passive losses. So depending on what gave rise to the gain that you use to fund the Opportunity Zone Fund investment, potentially you can use it there to offset the gain when the gain comes due. To your point earlier, maybe you pair it with a tax-aware strategy. So again, you've got 5 years to accumulate loss carry forward that then you can utilize to eliminate or reduce that 90 cents of tax on the gain that you deferred. So I think it's a huge benefit. It's predictable. It doesn't go away over time. And again, to your point, it's found money.
Well, thanks to Nick Rosenthal and the team at Griffin Capital for the conversation so far. This is a big topic with a lot of moving pieces, so we've split this episode into 2 parts. In part 2, Nick and I go deeper on how Opportunity Zones work alongside installment sales, charitable structures, and other post-sale planning tools. We walk through the Laurel Apartments project in East Austin as a real-world example, and we close with the questions a sophisticated investor should be asking before committing capital. Make sure you're subscribed so part 2 lands in your feed as soon as it's released. At Parsion Private Wealth, what we're known for more than anything is partnering with business owners and their families to unlock the true potential of their wealth, helping them keep more of what they've built for their family and the causes they care about most. As a result of working with us, our families tell us they feel more clear and confident on what the future looks like for them and their family. Each family is unique and requires a personalized approach to achieve these goals, which starts with seeking the guidance of a trusted expert. If we can help, visit us at parsionpw.com. That's PARCIONPW.com. And to keep up with new episodes of What's Next, don't forget to subscribe to our podcast on Apple Podcasts, Spotify, or wherever you get your podcasts. I'm Terry Cook, and thank you for listening. We'll see you in part 2.